Hi, this is Barry Haimo. Thanks for tuning in for another dose of bite-sized bits of knowledge, where we give you meaningful information in a short amount of time. Today we're jumping into limited partnerships. Limited partnerships have been around for a long time. They've been used for a lot of reasons, including estate planning, which of course LLCs have also started to become very useful as well. To form a limited partnership, you do have to file something with the state, and it is usually much more expensive than the other alternatives we've spoken about. For a limited partnership, there's a minimum of 2 partners. There's usually a general partner and a limited partner. Raising capital is similar to corporations and LLCs in the sense that you can raise more capital by issuing new partnership interests. You can also raise debt if that's a preference. In terms of their longevity, they can remain alive in perpetuity unless the partnership agreement says otherwise. Again, you need a partnership agreement. Operationally, they're very different. There are some requirements, unlike a corporation, but there's a lot less requirements than a corporation. Management, in terms of management, they're very different from corporations and LLCs. The way a limited partnership works is that you have a general partner and then you have one or more limited partners. Okay, the limited partners have no active role in the business. No active role in the business. They have a hat that says no active role. The general partners have a hat on that as the active role. They're the managers of the business. They're in complete control of the business, okay? You can be the same person with different hats, okay? But suffice it to say that in a limited partnership, the general partner is in complete control of the business. It doesn't matter if the general partner is a 0.1% owner. He or she or it is in control of the business. Okay, that's why usually in a limited partnership, the general partner is a company, is another entity serving as that general partner. Because guess what? The general partner is aside from the business liabilities, the general partner is completely liable for all of the business liabilities of the partnership as well. That's why I have a separate entity as the general partner. So usually you have an LLC as a general partner and a bunch of maybe trusts or people as limited partners. And again, the business liabilities are one thing, the general partner is also subject to those liabilities. So management is very different in a limited partnership. In terms of liability, I kind of just mentioned that general partners have unlimited liability. That's why there's an entity usually that encapsulates that liability from the people who are owners of that general partnership interest. The limited partners have limited liability just like a shareholder of a corporation or a member of an LLC. Taxation-wise, they're the same as a partnership. The partnership will file a 1065 reporting the gains and losses and the shareholders' identities and their respective shares of the gains and losses, which of course flow through down to the partner's personal tax returns via a Form K-1. In terms of interest transferability, it's really the same as a corporation or LLC. Interest can be transferred. The default rules will kick in, and under 620, for Chapter 620, you can find out those rules if you so desire. I'd recommend you do a partnership agreement that outlines what you want the rules to say, because again, you can modify almost all of them. Allocations of cash is different from a corporation. It's similar to an LLC electing to be a partnership, and it's similar to a general partnership in the sense that you can allocate the available cash to the partners pro rata or any way that you agree, as long as they have substantial economic effect, meaning that the agreement and reality are the same. That's great for investors. Investors like that because they can get their money back first, plus the preferred return with distribution preferences and so forth. You just can't do that in a corporation, whether C or S. In terms of dissolving, it's just as complex as a corporation or LLC. There's a lot of rules. Got to do it right. Get in trouble. In terms of who's it best suited for, I would say it's an expensive proposition to do them. I don't think that you need to do them. You can do them the same exact structure. We can mirror it or model it in an LLC, and you can do it a lot cheaper with an LLC. For tax purposes, they have historically been used in estate planning to take advantage of discounting. That's usually for estate tax purposes. And so, that's a tried and true method, but LLCs can be structured the exact same way. Now, I want to mention one more thing. Now, there's a lot of different kinds of limited partnerships. There's limited partnerships I just mentioned, which have the general partner, limited partner structure. There's also limited liability partnerships, which have a different structure. That's where you basically have a general partnership of limited partners. You'll see a lot of CPA firms and law firms that have LLPs. Think of that as like a bunch of incorporated entities being partners in a company. And there's also triple LP, which just gets crazy. So there's a lot of different ways to do this. You do see them a lot. They are relevant, but I think that for most businesses, there's better alternatives. So I hope you found this helpful. Please don't forget to download the Florida Business Entity Comparison Chart and our free business planning stress test. The links are below in our description. And thank you for stopping by, and stay tuned for more.